All right, welcome to Yahoo Finance's Morning Brief. I am Miles Udland here in our New York studio. I am joined this morning by Jessica Inskip. She is StockBrokers.com's Director of Investor Research. Jessica, a very happy end of the first quarter to you on this Tuesday morning. It doesn't feel, I was thinking about this earlier, it doesn't feel quite right to end the month and certainly this kind of a quarter on a Tuesday. Feels like we really need a Friday to cap it off, but I guess we'll do
it
like
would be a good Friday day.
We'll do like a double, a double conclusion on this week or something to that effect. So let's just start with, I think what the biggest impact that normal consumers are feeling right now, regular consumers are feeling right now as a result of what's happening in the market. Just this morning, the average price of 1 gallon of regular gasoline in the U.S. crossing $4 per gallon. It's the first time since 2022. And I'm just curious for your view on how you've looked at this rally we've seen in oil and the way that that is kind of, to me, like been a slow grind through different parts of the economy. And it doesn't feel to me like something that's towards the end, and maybe the beginning of sort of the impacts here.
Yeah, and I think it's such a good concept to think about, Miles, in a couple of different lenses. So one, the impact on the consumer, the impact that it has on the market, and then the impact that it has on monetary policy. So, and the consumer is obviously affected by all of it, but unaware of all the domino effects, if you will, that happens when something happens in the commodity market. So from a consumer perspective, I want to think about, I see so many headlines that say, okay, the last time this happened was 2022. That's when oil prices were this high. That was the Russia-Ukraine crisis, right? But we had such a different environment. Do you remember that environment from the FedWise where we were?
Yeah, well, I mean, I think something that I saw brought up yesterday is you had the Fed part of it, but you also had this massive COVID overhang labor market push on the inflation side of the ledger as well. And that's, yes. I think a little bit different than maybe the direction that we were going here, but it is like the backdrop against which you saw that rise in oil prices was so different than we're seeing now. And I'm almost wondering if I've undersold, like for myself, just undersold how different this moment is versus that. Because to your point, you say 2022, you start breaking out the comps, this, that, the other, but kind of a completely different environment.
It's a completely different environment. And I think that's something that analysts tend to miss, or self-directed investors miss all the time, is considering the environment in addition to the strategy and what's happening. So I agree with you. 2022, very different because of the COVID overhang, but we had a inflationary problem that needed tackled, and we were more on the beginning innings of a restrictive Fed policy. Now we're in the tail end, and yesterday, Powell even stated at the commentary over at Harvard that inflation was pretty tame in 2024, which I thought was such a statement saying that it actually was accomplished. But then we had all these other shocks come in, tariffs, and now this oil one where we've been really, really resilient. But my point is, we are now in an environment from a consumer perspective that demand destruction isn't the game right now. The risk, we're always looking at the risk of monetary policy, which is a risk to inflation on the upside, or does that outweigh the risk of employment? And right now, since we're trying to balance those risks, I think the risk to employment is a little bit higher, because this is going to constrain the consumer so very much, to your point, with the prices that are at the gas pumps right now in a very restrictive environment. That's my concern.
Yeah, and the other part of that as well, going back to the 2022 analogy, right? We'll use that frame. What was the word that got Powell and his peers at the Fed in so much trouble, really starting in 2021? It was transitory, right? Exactly. Yeah. So this idea that the inflation shock, which again, there had been inflation pressures building in the economy through 21 coming out of COVID, because you had really like a labor market push through pricing. So many more people had employment. Everyone got a new job in 2021. Felt like I got a new job in 2021.
The great reshuffle was happening.
Right?
Yeah.
And so there was just this incredible dynamism within the labor market and pent-up demand, which we can do that story as well. But all of this led to a Fed at that time that felt very confident inflation shocks of all manner were going to be transitory, and clearly they were wrong in that assessment. And what I think, looking at the balance of commentary yesterday, we heard from New York Fed President John Williams, we heard from Fed Vice Chair Chris Waller, and as you mentioned, we heard from Fed Chair Jay Powell himself, that no one's going to say that word again. But I am wondering if there is not some sense that the Fed can, I don't know, not have to react, let's say, to this inflation shock, whether it's because of the labor market piece of it or because there's just a skittishness around going too far the other direction, meaning they were so complacent in that 6-month period, call it like November 21 through the spring of 22. They were so complacent that now I think there's a real sense from those Fed officials that they don't want to come out this time and have a quick trigger to go and raise rates or really change the direction of policy. And I'm not, and this is all leaving out the fact that Powell himself is probably out of that job in a couple months.
Yeah, you got my brain spinning there, Miles. I like where this conversation is going. I think maybe that has to do with credibility and this dynamic shift that we're having with the administration, the way that he handled the presser in the last conference. Did you notice that? The second that someone just asked a political statement, he answered with the rest of anything political. Yeah, which I thought was great. He was prepared. He said, all right, let's get this out of the way. I may stay on as governor or on the board. I'm not sure yet. I'll do what's best for the institution. He just immediately had to play. But speaking to Fed independence also has to go with credibility. And I think something that I at least find when I'm on social media and I'm talking to clients or investors, inflation expectations and simply defining what that is, which on the most basic level is literally how we feel about inflation. My friend Callie Clocks said it really, really well one time, that $9 Caesar salad eventually is going to feel normal, but that normal works with long and variable lags. But what I've learned is people, when they think inflation's coming down, or when we say inflation is coming down on news outlets like this, they think it's literally going down in price. And what we mean is it's not moving up as high as fast. So when we have oil shocks and then tariff shocks, everything all at once, we kind of get numb to all these nuances. We get used to the shocks, we get resilience, but now we're expecting inflation, which removes that well-anchored expectations. It's literally us expecting there to be more inflation. So if the consensus and the verbiage around it is more cautionary, hopefully that will anchor expectations a little bit lower. And then, of course, we can dive deeper into the bond market and things of that nature. But I think it has to do with credibility, but also utilizing that tool, which is word of mouth. That is a very, very strong tool for Fed policy.
I would love to pay $9 for a salad. I can't remember the last time I've seen a salad that's only $9. And I think
you're in the New York area. There's difference in different parts of the country, but I agree with you there.
If you can find a $9 salad, I'll fly down to buy it. Your comment there made me think of something that is this concept that I've become very hot on, which is nominal versus. I don't know what I haven't figured out the second half of it is, right? But I think you're getting at where consumers experience and think about inflation. They actually don't think about inflation, to your point. Inflation is the rate of change in prices, but most consumers just think about the sticker price of all manner of things, whether it is a salad, whether it is their home, whether it's the cost of childcare, whether it's a car. I mean, you can't go to a dealer now and be looking at anything that doesn't start with a four handle, it feels like in many cases.
Yeah.
Average price of a new car in the US is 50 grand. So I think that nominal sticker price, let's call it discontentment that we see with consumers, is extremely disconnected, in my opinion, from the economic view of what inflation expectations are and this concept, as you mentioned, of well-anchored inflation expectations, which is really what most economists and Fed officials are obsessed with, this idea that they do not want to create an inflationary spiral, which is basically people would go out and spend as much money as possible today in fear of higher prices tomorrow, which would then push up prices today even faster than they were going to go up, so on and so forth. We can see how that plays out. But I think that like what we're really getting at here is the problem that whether it's the Fed, whether it's a company selling goods and services, whether it's a politician, whether it's an investor, there is like a nominal price sticker shock to everything it feels like people are consuming now that consumers have not shaken, are not going to shake, have no plans to shake. And I'm not a big like, oh, the economists in the ivory tower, Fed officials are out of touch kind of guy. That hasn't really been my position covering the Fed over these years. And I don't necessarily think they're going that direction now. I just know that the sticker price on too many things, it feels like, has gotten to a point where no one wants to hear about anchored inflation expectations. And I wonder if that's going to be like cold comfort for Fed officials who ultimately are not able to push and pull the economy to the extent they believed monetary policy could, or that monetary policy could or has in past cycles.
Yeah, I mean, it's the feeling that matters. I wonder if on car stickers we could have nominal and then real.
Or just like, hey, don't worry about the $50,000 price tag. This is only up 3% from last year. So really it's kind of in line with inflation. Yeah, people are going to love
this
that.
This could be a good time to buy. But that leads to two thoughts here, because you got my brain going in different places, is I think the self-directed investor underpins the value of understanding the yield curve and how that does affect everything that you borrow. And I did actually a series on my social media, and I started with that. So it's hard to get interested and say, hey, you need to understand how the credit market works in the yield curve, because it's going to affect everything that you borrow, even if you don't believe in the system, quote unquote, or whatever that is, it affects you so very, very much. And I even saw it where there was this trend on social media about during COVID. It started, of course, with YOLO and things like that. But then this very, very conservative investor with high yield savings accounts. And then when we moved, the Fed started lowering interest rates because they affect the front end of the curve. High yield savings accounts kept moving down. And even almost every day, I feel like I open on Threads, I see someone say, hey, where's a better high yield savings account? Mine keeps going down. And then I take the time to write a novel. I should really copy and paste something so I can put it in again, to explain how those are variable, and it's based on the front end of the curve, and it has to do with supply and demand, and how the Treasury, where it's based off of government debt. What the government pays for our debt is a baseline, or what the government pays for their debt is a baseline for what we pay for our debt. And so you have to care about that. And the reason why I'm giving you this really long answer based on the car concept we're talking about is it's a great time to time when you make purchases if you know how the curve works. We could look at the 5 to 6 years. That's usually tied to interest rates, at least for borrowing on cars. So we could be more tactical when we're accessing funds instead of having fear drive us with inflation expectations, quote unquote, or feeling like the cost of living, like we call it overseas, the cost of living crisis. That's definitely more relatable. That is higher. And so I just think it's interesting if we could shed some light to the everyday consumer, even if they don't invest in the stock market, just to understand how rates work, I think would make a huge difference.
Yeah, you brought up something there that is also, this is not like topical for today necessarily, but this idea of the YOLO investor versus the conservatism that I kind of think it's undersold, frankly, among younger investors, among individual investors, because you mentioned high yield savings accounts. There is, on the one hand, dynamics from pretty much any trading platform at this point. You can buy and sell just about any stock, individual stock, pretty much for free. You can execute all kinds of option strategies and learn all about them on YouTube at a very low cost. It's not going to be free, but it's going to be, what it used to cost 10 years ago, pretty close to free, right? And I think that gets a lot of play, like, the retail investor, just YOLOing, aping into everything, and then how this is affecting the market. But on the other hand, because you mentioned high yield savings accounts, I do feel like there's an undersold element of, let's just call it broadly our peer group, that says, I get 3% in a high yield savings account, and it's my money, and it's insured, and I'm just going to hoard cash. And I feel like this barbell approach is like really responsive to whether it's this inflation shock we started talking about, or I think just the complexity of normal life. Like, we're all now I feel like myself, I'm a financial product. I'm a financial derivative, just as a person who has a job and a family. But that feeling, I think, makes people very conservative in a lot of ways. And I think, your note on how many folks are looking for the best high yield savings rate feels to me indicative of something that doesn't quite get as much run as, again, that kind of YOLO trading strategy idea.
I completely agree. And I think this new cohort of investors, they should be smarter because they have access to so much technology. I mean, when I was learning about finance, it was in 2009 on the job, and I've had stacks of books and there wasn't as much content available to consume. And just as the market is dynamic and changing, we adjust Fed policy, the market evolves. So is this retail investor, and it's very, very quickly. We've got one end of the spectrum, which is those YOLO traders, diamond hands, and what they do on those forums. But there were forums in the .com era too. Let's not forget that. It's not new. And on the other hand, there's this index fund and chill cohort. But if we think about that and just purely market mechanics, it creates this consistent underlying bid if you're constantly dollar cost averaging into the markets. And that's what makes the markets go up, is just in demand over supply. Mm-hmm. And so I think it's good that there is demand coming from the retail investor. But what I think is bad is the lack of understanding market dynamics and how to shift from there. But I see it happening. It's like two ends of the spectrum, and there's this meet in the middle, which is where my content on social media normally covers, where they're trying to understand how the stock market works, how mechanics play into that, and even how the yield curve works, how we can look at the yield curve and see growth expectations, if inflation expectations, what that looks like, even how to layer on prediction markets and use that as an analytical tool, and how to utilize what we have to spot opportunities. And it's almost a beautiful thing having this different lens of an investor analyze the market in non-traditional ways, because it's like tackling a problem. If you bring someone in and you've been staring at it for hours, and then someone just says, oh, yeah, why didn't you just, a puzzle piece, just look right there. That's what I see this new investor doing. It's really interesting to me, but it's shifting market dynamics. It's changing regulation. It's changing what brokerage firms are doing. They're making a ton of money. It's interesting to see where they're marketing. And really, when we're understanding the market or trying to invest in a tactical way or seeking alpha, we're trying to see where the money's actually going. So I just think it's interesting, and we could talk about that probably for hours. Yeah. Sorry about the tangent, Miles.
Well, we have, in the 7 minutes we have, I would love to talk a little bit about, you mentioned just like the changing dynamics, opportunities, et cetera, like how you see the market today. Because I look at, and I think anyone who watches this show every day has seen for the last 3 days, I'm coming on here and just talking about how this isn't working. This trade's broken, software's broken, gold's broken, Bitcoin doesn't do anything, S&P 500's under its 200-day or was under its 200-day. Like everything just looks like a mess in the market. I'm curious, given all the different ways that you layer on, whether it's a fundamental scope or a technical scope or kind of this flows, a bid scope, let's say. I think flows probably be the easiest way to say it. Like all those different lenses that you layer on, how you see the setup today, what's interesting to you, what isn't working, and just what has your interest as we again wrap up one of the more compelling first quarters that I can remember.
It is a very compelling first quarter. So I do like to start with the environment. Right now, we're in an environment where we have a very resilient consumer. We have a very resilient corporate America, and there are shifting market dynamics since post great financial crisis, which I think we could spend another 30 minutes on, and I can go down rabbit holes. So I'm going to avoid that, Miles, just to answer your question very directly. We are in a bearish trading cycle, but that has to do, of course, with oil because of the uncertainty that was introduced. Uncertainty equals volatility. When we have volatility, then it goes into higher term premium, and then that crushes valuations and accelerates a sell-off. So I think it's very difficult to find the bottom, but what we're looking for is just an area of supply or resolution, and it'd be interesting to do that. So I like to look at the 200 weekly moving average as a very low bottom. We are not even near that. But what I really care about is the 13, 26, and 40 weekly moving averages from a technical perspective. If you were to put that on a chart of a year and a half to 2 years, you could very easily see how the market turns over when those moving averages start to cross and slope downwards, don't act as support and begin acting as resistance. I get asked all the time, for someone who's never followed my work, why I use the 13, 26, and 40. It's very simple. We just finish up a quarter. We look at the market quarterly because we report earnings quarterly. 13 weeks is roughly one quarter, 26 to 43. So I'm looking at price action and what is happening on a quarter over quarter basis. And when it rolls over, we get in what's called a bearish trading cycle. And that's where we are on the equal weight index and on the market cap index. So the S&P 500, driven mainly by technology, a huge part NVIDIA, equal weight, we're going to spread it all evenly. Now, the environment, which I think is interesting, is the last time that we hit this trading cycle was last year when we had the tariff scare. We, of course, bottomed right when the Fed actually introduced interest rate policy. If you draw a straight line going back to 2022, it is very, very interesting to look at that. Nonetheless, I digress. At that point, analysts were re-rating down. They were giving us earnings revisions downwards. That's not happening right now. They're holding the line. So we've got price moving down, earnings staying consistent or even moving up, re-rating higher. I believe it was adding $10 even last week. A lot of it is software too. So that tells me that two things. One, we're learning from the taco trade, quote unquote, or the fact that the market is always coming back. And so when analysts re-rate down, they're re-rating back up. Great. We don't have that accelerating the sell-off. And I think that might be why it's difficult to find a bottom from a technical basis until we have some type of fundamental or news-driven headline that will take us out of that. Then on the other hand, because we got to talk about both here, if we haven't re-rated down and we need to re-rate down, then that could accelerate a sell-off. I do think that we have a healthy earnings environment. Earnings was broadening beyond the AI narrative, led into the efficiency narrative. There are so many headwinds that are going to help the market with fiscal policy even, but also those headwinds are tailwinds for the inflationary picture. So essentially, the way I look at the market, everything is a if this, then that statement. So right now, if everything stays the same and we get an oil resolution, we're going to have a lovely, lovely rally. If this is longer than anticipated, and I'm looking at May 14th when President Trump is going to meet with President Xi over in China. That I think is the big end date for me, and he's going to need something resolved by then, and I think he will, but no one knows, including myself and those experts out there. We don't know what they're thinking. But if that happens, that will set us up for a good environment. Yep. But if it's longer than anticipated, we'll get those re-rates down and then it will accelerate. But if we look at companies with healthy free cash flow, I still love the AI narrative. It's true. It is amazing. If you use AI, it changes your life. I've rambled on you, Miles, but I think there's a lot of opportunity. All right.
We will leave it there. And next time I will get your guess on what you think the Fed does or doesn't do this year. But maybe we'll connect on that one offline. All right, Jessica Inskep, thanks so much for the time this morning. And that does it for the Yahoo Finance Morning Brief. Much more ahead on this Tuesday. Opening Bid with Brian Sazi is up right after this.
Good Tuesday morning. Welcome to Opening Bid. I'm Yahoo Finance Executive Editor Brian Sudsley, coming to you live from our New York City headquarters studios. Love this place. Did you catch that breaking big food merger news between McCormick and Unilever this morning? If not, head to Yahoo Finance's homepage. I just dropped a story on it at the same time as I'm standing here. It will see the Old Bay flavored Hellmann's mayonnaise likely on the way. I'm not sure. I just thought it was an interesting thing to put in here. Now, every morning I stand up here and I fire off a handy list of cool things in the market and on social media that you may find helpful. But my opening bid roundtable is just so darn awesome today. I want to yield all my time to them. Jim Bianco, Bianco Research President, Caleb Silver, Investopedia Editor-in-Chief, and Senior Markets Reporter, Inez Frey, all here for some opening bid fun. Jim, I want to come to you because I think what you recently just wrote on X sets the tone for this whole conversation. You wrote it would be an economic disaster if the president pulls out of this war without reopening the Strait of Hormuz. Explain to how much of a disaster would that be economically?
Incalculable. Basically, you would be elevating Iran to a superpower. They would own the Strait of Hormuz. They would set the price of oil. It would be hundreds of dollars of a barrel. Only their oil would get out, and they would probably try and use it to crush the West. You don't want to have that. Look, whatever you want to argue, we went in, we did a war, and look, I was kind of in favor of it, but now we're stuck. They own the Strait of Hormuz. They can't own it. We have to get it open. And that's just the reality that we live in right now. We could namesake all we want. We could say it was wrong, but now we have a task in front of us.
Jim, I like that economic reality check. Let me stay with you here for a second, because how do you think this economic data over the next few weeks will unfold? I'm going to write off this non-farm payrolls report later in the week, but I'm really more focused on the consumer sentiment data, manufacturing surveys. What is the aftershocks of this war? Because if you look at the broader stock market, yeah, it's declined off the highs, but it hasn't necessarily priced any of this in, I would argue.
Yeah, I think to your last point, I think what the stock market is doing is it's holding kind of like I do, even though I was kind of negative there in the beginning, a belief that the U.S. military has a plan to open the strait, and that maybe in the next week or 10 days, and I keep saying that in the next week or 10 days, there's going to be a plan. So the market doesn't want to totally panic and take the price of crude oil to $150 or $200. And it doesn't want to dismiss it and take it back to 80. So every day it goes up $3 or $4 because every day goes by, we don't open the strait. As far as the economy goes, U.S. economy, I think, is weathering this okay. Yes, the price of gas is up over $1 a gallon, and nobody likes it. But commerce is moving. So all we're getting out of this is higher inflation, and that's why the response has been much higher interest rates. The 10-year yield is up about 40 or 50 basis points, almost 0.5% since the war started. And as the price of crude oil goes up, I think interest rates will continue to trend higher.
Caleb, you like me, I would say, are connected to the people on the ground. I mean, we still talk to a lot of average consumers across this country. How big of an impact is it now that we are at $4 a gallon of gasoline on average in this country? You go to California, it's now touching $6 and even higher depending on what station you go to.
Yeah, it's both psychological and it's actually very real for the people that have to fill up once, twice a week, or if you have that small business and you have to fill up the fleet. But I think it's the anticipation of higher prices to come that is going to what has got its grip on consumers right now, and this negative downbeat of consumer sentiment. I think we're at multi-year lows on that. And eventually, it's going to bleed its way into spending. We're already starting to see it with some of the airlines. It's really the top of the barrel that's got everybody's attention now. That's gasoline. But when you go to the bottom of the barrel and you get to that crude, the diesel, the jet fuel, all the things that power the supply chain, that's going to make things more expensive down the line. The good news, if there's any good news, if you look at oil right now, it's got that backwardation chart, big term that's been ringing on Investopedia, and that is traders anticipating that oil prices are going to be much lower by the summer, back down to $80, $90 a barrel. And then if you get to the end of the year, they're looking back down to where they were before this whole thing began.
And as I think what Caleb just said brings up a good point. This is a stock market looking past this turmoil, hoping beyond hope that oil prices go back down to below $80 a barrel by the second half of the year. But I know, based on your reporting, nowhere is that suggested that is a guaranteed thing to happen.
Not right now. I mean, you have Wall Street that is saying if the conflict sort of subsides in April and doesn't go beyond that, then you would see oil prices. You've got Societe Generale that's talking about $125 oil for April, perhaps spikes to $150. But really what traders want to see is the Strait of Hormuz open. That is what they care about, and that is why you're not probably seeing oil going much lower right now, is because it is still closed, essentially. Also, you have now the risk of the Red Sea and the Houthis that have entered the conflict, and the Red Sea at risk as well. So all of this is pointing to still this massive supply shock. This is not a demand shock, Wall Street is underscoring. This is all to do with supply and the physical oil that is not coming out of the ground, and that's why you're seeing these higher prices. And if this conflict does resolve quickly, this is still going to be a slow recovery, because you have some of this infrastructure that will take months, if not years, to come back.
And that's an important point, Naz. Let me stay with you here, because just because, let's say this conflict does end, or we get a signal from the president that he's going to exit this war in some capacity soon, that doesn't mean gas prices instantly go back to, what, below $3 a gallon?
Right, exactly. Gas prices take a while to come back down, and it will all depend really on the price of oil as well. So right now, as you mentioned, $4, that is a psychological level for consumers. Whatever they're spending on gasoline, they're not spending elsewhere. And right now you have this sum of $8 billion additional dollars that were spent cumulatively by Americans because of the higher gas prices over the last month.
Jim, are there certain economic indicators you're watching right now that are starting to break down or flash, I guess, more cautionary signs on the economy's near-term direction that is factored into stocks?
Yeah, I keep in mind that 40% of S&P 500 earnings come from overseas. And I've been watching what's been happening overseas. There is gas rationing in Australia. There are fistfights in India over gas because the stations are running out of it right now because they get all their oil from the Middle East. And really what I'm watching is all these companies that want to sell overseas. Are they actually being able to see what's their customer base looking like? Europe, we're going to have to deal with a stronger dollar, because in a world of uncertainty, the dollar will continue to go up stronger. So that's why what I was saying earlier, I get it. $4 gas is terrible for this country, but man, be lucky you're not Australia, because they would happily accept what we've got going on, because it's far, far worse there.
Good note out this morning, Jim, from the Goldman Sachs team, calling out they're I guess advising their clients to invest for a stagflationary environment in European equities. It wasn't exactly a ringing endorsement, but how do you play these overseas markets? And to your point, this comes at a time where many countries are rationing gas, and I know I just recently wrote about this for us here at Yahoo Finance. That is starting to really impact restaurant operators overseas.
It's not. It's restaurant operators, it's manufacturers. Before the war, I've referred to it as the February 27th economy. We were talking about a broadening of the stock market rally. We were talking about people going international. And that was a valid theme, and it was working. But this war seems to have just turned that right on its head, because really the most acute pain that you're seeing right now is everywhere else. We are not immune from it. We got $1 higher gallon, but man, you look anywhere else in the world and it is far worse. And I think that that's starting to turn the investment theme right now away from those markets and more towards the U.S. market. Now, maybe, the war ends soon and we go back to that kind of environment again. I'd like to hope that that's going to be the case, but it isn't right now.
Caleb, I'm thinking about your perch over there and all the publications and things that you oversee. I'm looking for recession indicators. Are you, like food and wine, for example, are people searching for sub $20 wine bottles? Is that where things are headed?
No, not necessarily on food and wine, where the readership is looking for something, they're looking for value. And I think that's the thing that you find across the publications, whether it's travel and leisure, whether it's food and wine, whether it's, even real simple. People are looking to still be able to afford the things that they want. And that's that keyword affordability. That's on everybody's mind. So they're looking for value. But when you look at the tendencies, especially as we head into the summer months here, where everyone was headed to Lisbon last year, or a lot of people were taking those trips to Japan, we're seeing a lot more domestic interest. We're seeing a lot more interest in the regional vacation versus the big flight overseas in a couple of weeks in a country where you thought the dollar was going to take you a little bit further in terms of where it was last year. So there's that. And there's also people on Investopedia and throughout our sites looking for the best place to put their money right now. And all of a sudden, banks are looking sexy again, and so are CDs, especially in the short term, looking at spikes in short-term CD rate inquiries on our site.
Caleb, you must have saw my notes, because that's exactly what I was going to ask you about CDs. Of all days to ask about CDs, you go to Investopedia, right rail, you have all the CD rates listed out there very clearly.
Yeah, people are looking for that. People are looking for safer places to put their money in a time of uncertainty. We've done very well as investors over the 3 years of this bull market, and all of a sudden there's all these dynamics that investors feel they can't control. What they can't control is where they feel safer. It used to be gold, but now it's back in the bank.
I'm surprised, Caleb, that we have not seen business travel come in a little bit. I'm just ingesting a lot of research, and people that I'm talking to, prices for airfare tickets have gone through the roof.
Yeah, but the in real life experience, especially in business right now, especially in terms of client entertainment, that's huge right now. And if you look across sort of our industry and media, that's one of the only places where you're seeing a lot of really strong activity. People want to get back out again. You're seeing that. You're also seeing, high-end spending in the very front of the plane doing very well right now. The bottom part, obviously, the back of the plane not doing great.
Yeah, it's all about that first-class experience. It has one place that is still not a safe haven. It's Mag 7. Those stocks still continue to trade absolutely awfully.
Yeah, data correction or deeper for a lot of them. Look at stocks like Microsoft, which was, one of the strongest stocks in the market over the past few years, and really over the past couple of decades. That's down, around 30% or so. So we got stocks like that in deep declines, and these are the stocks that retail investors hold the most dearly. They're the biggest holdings in their portfolios, or the biggest holdings in all of the big ETFs as well. And when we ask retail investors, and we ask our individual investors every time we survey them, what are the biggest stocks in your portfolio? It's the Mag 7, it's the FANG stocks, and the stocks that have taken so much punishment over the last 6 months or so, and they still hold on to them, and they still say that they would buy them and hold them for 10 years if given the opportunity. These are the stocks they've been loyal to, and we'll see how long they're willing to keep up that patience.
Inez Frey, last word to you here. Maybe Apple turning 50 tomorrow. Maybe that'll help jumpstart the Mag 7, Inez.
Look, out of the Mag 7, Apple has done a very well, the best recently, outperforming last week. If you took a look at what happened last week with the Mag 7, Apple actually was slightly in the green. So I think their Siri developments are helping there.
Hopefully for them. All right, Jim, Caleb, Inez, so good to see you. Awesome analysis as always. All right, a big moment in the history of wearable device maker Whoop as it looks to gain further ground on rivals like the Apple Watch and the Oura Ring. More on this next with a special guest. All right, Whoop doesn't appear to be running toward an IPO, but it just got another very healthy injection of capital. The wearable device company said today it raised $575 million in Series G funding at a $10.1 billion valuation. The funding round includes a who's who of top athletes that have long used the Whoop device, such as LeBron James and Rory McIlroy. Whoop founder and CEO Will Ahmed is here with me now at Yahoo Finance HQ. Will, good to see you. I must say, full disclosure, I am wearing this. You know, I've been a long-time user of the Whoop strap. It's great. It works.
Well, thanks for having me on. Thanks for being a Whoop member.
Yeah. Big capital raise here for y'all. Take us through the process. Or how did you decide to raise this slug instead of, I guess, going public?
Well, we've seen really extraordinary growth over the last 12 months for the business. You know, we've essentially grown our bookings by over 100%. Our member base is now 2.5 million members. And it's not just growth in the US, it's all around the world. So Whoop is in 60 markets now around the world. We're seeing lots of pockets of growth. And it's also a time, I think, when health monitoring has never been more popular or more important. You know, there's a huge push around longevity. And as a consequence, we really saw a lot of enthusiasm from investors. And we put this round of financing together. It was led by Collaborative Fund, who we've known for 12 years. They actually initially invested in our seed round. And then we also wanted to bring in really a wide collection of strategic investors. We've got a number of sovereign wealth funds like 2.0 and QIA and Mubadala participating. We've got investors from Australia, Macquarie. We've got investors from the UK, GP Bullhound. We've got a bunch of existing investors following on, IVP and Foundry Group. So it's a really great collection, and I'm particularly excited about our new health investors. Mayo Clinic has participated in this round of financing, obviously one of the great health institutions in the world in terms of research and capability. Abbott participated in the finance, one of the best medical device makers in the world. So we're very excited about this collection of investors, and we think there's a lot of growth in front of us.
I remember when we first met you, I think it was at the start of the pandemic, you'd always come on remotely with us, and I remember talking to you back then on how I viewed Whoop as an AI play, but I'm hearing you now, longevity, health companies, like what is your ultimate vision? As I mentioned, I'm a member, I see what you're doing in terms of health, I can upload my health records on here, but what is your ultimate vision going forward for this?
Well, we want to ultimately build the most powerful personal health platform, which is to say that you come to Whoop if you want to understand your health. If you want to improve your health, if you want to understand it, you come to Whoop. And what that takes is, obviously a very powerful sensor and being able to continuously measure the human body. It also takes a lot of other data sets. We recently launched Advanced Labs, which allows you to do blood testing through
Right.
Whoop. You're going to see us continue to add more and more sensing and capabilities. And then lastly, it is AI, and it's being able to provide insights to our members and alerts to our members that they wouldn't otherwise be able to get. And so this combination of health sensing and big data and AI, we believe is going to pave the future for a very powerful new wave of health monitoring.
What else do you think my Whoop strap will be able to sense?
Well, you don't have to look too much further than cumbersome, antiquated medical equipment. If you go back in time to how the company was started, it was, hey, can we replace an electrocardiogram for measuring heart rate variability? Can we replace a chest strap for measuring heart rate? Can we replace a PSG machine for measuring sleep super accurately? And we've been able to do pretty amazing things in this form factor. Obviously, in the last 12 months, we announced Blood Pressure Insights, which allows you to measure blood pressure non-invasively from your Whoop. And you're going to see us continue to invest in new capabilities like that in the coming year.
What do you get asked from the likes of a LeBron James, a Cristiano Ronaldo? Because I viewed your early work with athletes as helping drive awareness for this product. Like, how else are they trying to improve what they do?
Well, we're very grateful to have LeBron James as an investor in this financing, Cristiano Ronaldo, Rory McIlroy, Virgil van Dijk, Matthew Vanderpool. The list really goes on. And so it's been extraordinary to get to partner with these athletes. And they always give us great feedback on the bands and the materials and where they can wear it throughout their body. And I think ultimately Whoop wants to ground health monitoring in an aspirational place. If you look at medical technology historically, it's been a very stigmatized space, which is to say that if you wore a medical device, people would ask you, what's wrong? That's like the opposite of inspiring or aspirational. And so we're proud that we've built a health monitor that's worn by the world's best athletes and highest performers because it creates this aspirational halo for health monitoring. And it makes it something that's not only a good thing to do, but it's an aspirational thing to do.
Is the next step for Whoop an IPO? Is this is the final tranche of private capital, and then you will now set the tone for going public?
Yeah, it's our expectation this is the last private round of financing that we'll do. I mean, the business is now operating cash flow positive and did in 2025. And so ultimately this $575 million, it really strengthens our balance sheet, and it gives us a lot of control over our destiny from here. We've announced that we're going to be hiring 600 people this year. So
hiring, a tech company hiring.
That's right. We have a big commitment to human talent. We believe in human talent.
Take that, AI.
I think humans plus AI beat AI every day of the week, at least for now. And so we're making a big commitment to growing our talent base and our team and investing in careers. And I think in the long run, there's just such a big opportunity in the space. I mean, the healthcare space is so broken. Health monitoring is getting so exciting. What AI is allowing you to do with all this health data is so powerful. So it's just a great moment for the company.
A couple fun ones, because my entire gym class knew you were coming in, and they had questions for you. One, first up, will the Whoop strap ever come with a screen that just tells the time? That's it. That's all they want.
No comment on its watch-like capabilities.
Okay, fair enough. Number two, what about earrings? There seems to be a lot of interest now. You look at the Apple AirBuds. Is that a category you would have interest in getting into?
I mean, look, we're always evaluating sensing from every location on the body. We're looking at a lot of different capabilities beyond even what's I think traditionally thought of as health sensing. We're looking at new capabilities that aren't in the market that are, I would say, more experimental. So the whole space at large, we're constantly looking at how can we push it forwards.
Last one for me. I work out actually a terrifying amount each week. Why isn't my age score going down on the Whoop? What am I doing wrong? Am I not getting enough sleep? Like, what's the hack here?
Well, it might be you're not getting enough sleep. You might be overtraining a little bit, Brian. You got that mindset that you can just go.
Yeah.
It may be that you need to improve your VO2 max.
I'm trying. It's gone down. It's gone down with all these workouts.
Okay, so that's problematic. If you're exercising a lot and your VO2 max is decreasing, we might want to relook at that workout program. We might need to have a call with your trainer, get the guys from the gym on the phone, figure out what's going on.
Yeah. It's been a joy to see how much you've taken this platform. Look forward to that big day for y'all and big day for you on the capital raise. We'll talk to you soon.
Thank you, Brian.
All right, appreciate
it.
All right, straight ahead, Market Catalyst dives back into a market just hoping its next move isn't much lower because of sky-high oil prices. We'll be right back.
Welcome and good morning. This is Market Catalyst. I'm Brooke DePalma. We're 30 minutes into the U.S. trading day, and we are off to a hot start. Let's take a look at all three major averages. We do have the Dow up about 1.4%, the Nasdaq up more than 2%, and the S&P 500 now recovering off of yesterday's losses, up 1.7%. And if we take a look, what we saw over the past 2 days is this sell-off. This was the first time that the S&P 500 had sold off, or rather closed with losses since we started this war on a Monday following losses on Friday. Typically what we've seen is the S&P 500 move higher following Friday's losses, but not the case yesterday. But now we're seeing this return to momentum, up more than 1.7%. And largely what this market continues to be focused on is that war in Iran. There has been optimism that we could be nearing the end. And so what we're definitely seeing there is a reversal here. Taking a look at where we are now with crude oil, we are seeing a bit of a reversal there. Crude hovering around $102 per barrel after opening, or rather hitting as much as close to 105 per barrel this morning. Also Brent, which was on track for its largest record monthly gain, still seeing a bit there. It's down about 0.5% this morning. And also taking a look at some sectors that got hit the hardest. We did have the Mag 7, the Nasdaq, seeing momentum down there, but not today. The Nvidia, Google, Microsoft, Amazon, Broadcom all up more than 2%. Meta up 3.7% this morning as well. And that's really extending into the chip stocks as well. Semiconductors mostly in the green, or if not all in the green this morning, with some up as much as ARM up 6.7%. Taking a look there after it's been quite the month for this company. Taking a look over the past 2 months, we actually have been up about 40%. But month to date, taking a look at what we've seen this past month, also seeing momentum there. So that's holding on to there. Also continuing into software stocks, take a look at that as well. Taking a look at equal weight, we see mostly green across the board. So definitely a strong start to the last day of trading for the month and a strong start to the last day of the quarter. But U.S. stocks are showing these signs of optimism that the war in Iran could be coming to an end despite the potential for a prolonged energy shock. Still, Wall Street's biggest bull is standing by his year-end target for the S&P 500 of 8,100. And joining me now is John Stolfus, Oppenheimer & Co. Chief Investment Strategist. John, that bull in the market is you. You still have this year-end target of 8,100. What needs to happen for us to see that at the end of 2026?
Well, first of all, thank you for having me on the show. Great to be on Yahoo Finance, as always. Must say that, when we look at it, we think the fundamentals in the U.S. remain the same. The attractiveness of the resilience that remains in the economy across business and the consumer, even as the consumer slows but selectively keeps shopping. We've got to say that with the Fed doing what it's supposed to do, keeping inflation in check, riding herd on its dual mandate, 8,100 still looks very feasible. We've got to remember last year at this time, we saw the market in the process of getting ready to go down to, I think it was down 18.9%, and then rebounded. So we were when the market closed last year, we were at 96.4% towards our 7,100 target last year, which underscores the resilience in the market, which we think remains today.
John, we're hearing about the possibility of this war ending, but without the Strait reopening. So what are the market implications there should that happen?
Brooke, I've got to say that a lot of this has to do with, understanding, and I don't know who understands it. We certainly are trying to be students of it. The art of the deal. It seems like every other day, sometimes within the same day, the president will issue contradictory statements, which are likely used to befuddle the enemy, we would think, and keep everything in abatement in terms of what's the U.S. going to do next. I think the point is, from what I can tell, this is neither a political statement, but it's an observation as a strategist, is it would appear to us that the president's message is that Europe has to take the role of opening up the Strait of Hormuz, and the rest of the world does, not just the U.S. So he wants to have us move away from taking everything on in terms of curbing what has been a very difficult relationship with the world between Iran and the rest of the world, and even its regional neighbors. He's trying to get them to share.
John, I do want to point out something on our screen right now. You do still have an underweight performance on energy, but we have seen it outperform over this past month. What's your take on that? And moving forward, should that change if this war does keep going?
Yeah, that entering at the end of the fourth quarter of last year in portfolios that we managed, we had maintained exposure to both integrated oil as well as to refiners. And we continued that through this year. So our actual percentage in our portfolios is substantially over the underweight that we put in last year. We'll be looking to address that probably now that we are at the end of the first quarter. I can't tell you if we're going to raise it, if it'll stay the same. We would expect oil will come off the boil as soon as we get an idea of when that Strait of Hormuz that takes, as we all know, we hear it over and over again, the 20% of the flow of oil that the world needs goes through there. Once that is reopened, oil prices will probably normalize to what we'd gotten used to in an area of somewhere around 60 to 70, high 70s per barrel.
John, you mentioned at the top that you want to make sure that the Fed is doing what they can to keep inflation in check. Now, yesterday at a speech at Harvard, Fed Chair Jerome Powell had said that he believes that interest rates are in a good place right now. And that sort of backed the odds that the Fed would have to hike. What's the inflation risk here? And what do you think the Fed's next move is?
Yeah, I think that the next move of the Fed is to probably stay on hold as long as oil prices is where they are, either at triple digits or just under triple digits per barrel. And with that kind of expectation, we would think that the Fed is likely this year, after the change in leadership at the Fed, at the most going to cut once, and then it may very well, just to show that it can do it, that it believes that inflation has been curbed enough. What we have here, I've been in this business for 43 years. It doesn't mean we're right all the time. Mm-hmm. But, the old adage is what Mark Twain used to say: history may not repeat itself, but it often rhymes. And the worst thing you can do during periods like this is project negatively to the nth degree the outcome, because all sides feel pain. All sides eventually come to the table. Cooler heads prevail.
And one thing that we have seen is investors maybe not turn to what once known as a safe haven, gold. Gold futures are down about 11.5% over the past month. But yet, if you take a look at the poly market users, what we're seeing is the odds of gold reaching $6,000 an ounce by the end of this year rising. So do you think that we could see a return to gold, or is this a good entry point now to get in?
Related to gold, we own some in portfolios that I manage. We had bought it ages ago. I don't recall. I think we bought it around $1,800 an ounce, and it was like a lead brick in terms of contributing performance. And then, of course, over the last 2 years, it's been remarkably strong, and we've seen it rise to the current levels, and then fall somewhat from that to even a bear market at one point. And then I think by the end of last week, it was just down 17%, so out of the bear, so to speak. You've got to remember what really is powering gold this cycle is that you have central banks buying. So you have normally, and you currently have it, you have private investors, money managers, gaining exposure to gold because they're concerned about inflation from a traditional sense. And yet what really we believe is powering it is central banks buy in size. Who are they? It's China, it's Russia, it's India and Saudi Arabia. And the reason why they're buying gold is to hedge their currencies by backing those currencies with gold against the dollar. The dollar relies on transparency, governance, and the size of a $31 trillion economy to define its value. And we saw when the hostilities broke out in the Middle East, the dollar strengthened. It didn't weaken, it strengthened. Everybody runs to the dollar when it looks rough on a geopolitical basis. But the dollar will likely come down later this year once we get through this period. And the Fed begins if the Fed cuts once, or you get a feeling that could cut once or even twice, you'll see the dollar come down. Then you got to remember the dollar actually, when it comes down, benefits stocks in the S&P 500, some of which derive over 50% of their revenue from foreign sales.
John Stolfus, thanks so much for all your insight. I really appreciate your time.
Thanks for having me.
And for more Polymarket odds, you can scan the QR code on your screen to go to the Yahoo Finance Prediction Markets Hub, powered by Polymarket. The national average gas price is hitting $4 per gallon for the first time since 2022, rising about $1 since the start of the Iran war. Yahoo Finance's Jay Conley joins me now on set for more on these latest moves. $4. We knew we would get here eventually, but now we got here. So what exactly is driving that $4 mark, and could we expect this to stay?
This is that underlying crude oil price. You look at U.S. crude prices, which is driving most of this gasoline increase. Not only is crude oil up 50% over the last month, but that makes up about half of the price you see at the pump. So when crude oil is going up, fuel has to follow. This is now the greatest monthly rise on record for gasoline, also for diesel, where the same thing's playing out.
Right.
But you're going to start seeing this way on the consumer because there is a difference in feeling when you pull up to the pump and see a 4 handle instead of $3.99.
Yeah, and
there's a different feeling.
Our guest yesterday was even saying that like $5 would be the true psychological impact on consumers. Don't think we're getting there though.
It depends on duration.
Yeah.
We've said this over and over again. You and I talk about this at the desk all the time. It's about how long does this war go on? How long does the Strait of Hormuz remain blocked? How long does the oil market keep feeling this pain? But you already see this in consumer sentiment data. You look at the University of Michigan's consumer sentiment data. Consumer sentiment is currently at its lowest level, lower than the 2008 financial crisis and the 2001 tech collapse.
Yeah.
And so you already see consumers really hurting on the back of these fuel prices, even if it does make up a small chunk of their actual spending.
Right, and I think it'll be so interesting to see how this all plays out, because what I've learned is that these retailers, these gas retailers, they're looking at what the cost of their next shipment would be. So if we're seeing stocks move higher, if we're seeing oil sort of come down, then how are they thinking about next week? Will be interesting to play. But we're also looking at diesel, we're looking at airline costs. How does this all sort of play in? Because we did hear from President Trump this morning saying that all those countries that can't get jet fuel because of the Strait of Hormuz, he sort of said, buy from the U.S. or build up some courage here and get to the Strait yourself.
Right, go get your own.
Yeah.
Well, you look at what we call refined products, right? That's gasoline, diesel, jet fuel, marine fuel, all these products that you take crude oil and then make with that crude. Crude oil is up 50%, 48% on Brent over the last month. All the derivative products are up much, much higher because margins are tighter. There's less capacity. Refineries are already running at capacity, so they don't have room for more output. Already you're seeing this play out in the jet fuel market, which has doubled. Diesel is up very heavily. Airline prices, as we always talk about, they're already going up to adjust here. Now, President Trump's comments, come buy American, sure, the U.S. doesn't produce a ton of jet fuel, around 1.5 to 2 million barrels per day. Most of that is for domestic consumption, but I'm sure you could find buyers in the international market. I think the bigger signal here is that the U.S. doesn't want to be responsible for having to kind of police the Middle East, right? You've seen President Trump saying from the Wall Street Journal this morning that maybe I'll pull out of this war and leave the Strait as is and let Europe and Asia and,
kind of figure it out
and
for
the
themselves.
Gulf region figure it out for themselves, exactly. Which then, what's Europe going to do? Are they going to buy American? Are they going to solve that crisis? It's going to be a big unknown.
Yeah, and lots of ripple effects as well to watch out for if this strait doesn't reopen, it seems like.
Exactly.
Oh boy, well, thank you so much for breaking it all down. Appreciate your time.
Thanks, Brooke.
All right, and coming up, there's just over 2 weeks left to file your taxes. We'll unpack what you need to know as the deadline fast approaches. You're watching Market Catalysts. The IRS has received nearly 80 million tax returns so far this year, with the deadline just over 2 weeks away. Let's discuss what last-minute things may need to get organized before that April 15th deadline. Joining me now is Mark Stieber. He is Chief Tax Information Officer at Jackson Hewitt Tax Service. All right, so break that down. If you haven't filed yet, what is your next step?
You got 374 hours.
Okay.
You need to do three things. You need to get a plan, and your plan needs to be, one, find your documents. You should have them all by now. If you don't have them, hope's not really a strategy. You need to get on the phone with that bank, broker, K1 and get that document. Two, find someone to help. If you waited till now, you clearly don't enjoy taxes or money.
You're putting it off.
Find some people. We got extra help. Everybody's got extra hours, weekends, whatever. And third, commit. This is the real big part. You need to set a date, and I know this weekend's kind of a holiday weekend, but you can still find people to get you help. But commit to a date and get it done. Then you feel really, really bad because the 15th is not the date.
Yeah.
I mean, that is the date, but you don't want to wait till then because somebody could ask you about your tips or your overtime or your new car or whatever. Then you really have to scramble. So.
And if you're listening now and you're like, oh my gosh, I can't even believe that tomorrow is April 1st. How do you file for maybe an extension? Is that a possibility?
Oh, extensions are great. Tax pros love extensions because you get to pay twice. You get to pay us to do the extension, then you get to pay us to do your tax return. Most people don't really need to file an extension, and the misunderstanding that many people have is it's not really an extension of time to pay. If you owe, you got to pay by the 15th or have penalty risk, and extension doesn't solve that.
Right.
And you just send your paperwork in later on, but really, if you've got all your data and you really can get it all with about a phone call, except in really isolated cases, no good reason to wait.
Now, you have to pay back. If you do owe back, you do have to pay it by April 15th. What's the consequences if you don't?
Bad.
How bad are we talking?
25% penalty just off the start for failure to pay, 25% more penalty if you don't file on time, and another 25% if you haven't paid throughout the year, plus interest, which starts compounding daily on the day of, plus you have to pay someone to clean it up. So in many cases, the penalties, the interest, the professional fees can outweigh the just get it done. That's why
interest day by day, that has to add up fairly quickly.
That does add up. In many cases, I've seen this personally, that the tax, the penalties, the interest, and the professional fees are larger than if you just paid someone to do it up front. So,
oh boy. All right. So do make sure you do it by April 15th. But are there any deductions that maybe people don't realize that they could take advantage of right now, especially following that one big beautiful bill?
Millions and millions of dollars each year. And it's not really the highly publicized ones like in the big beautiful bill.
So what aren't
people
the
like the tips? You know, there's confusion on those. A lot of people think, well, I don't have to file a tax return because all that bad social media misinformation that's out there. The overtime deduction, $12,500. You have to put it on a form, but you don't have to itemize. The $25,000 tip deduction, really nice. We're seeing a lot of that this year, but you have to put it on the form to get the deduction. The new $6,000 senior deduction, just for being a senior. You don't have to be getting Social Security. You don't have to be in retirement. You don't have to not be working. You just need to be 65, and you get a $6,000 deduction. And those add up to big refunds. Now, the ones that you don't hear about with your life changes, those get overlooked a lot. Like if you moved, or you started a new job, or got married, or had a child, or started a side hustle, or trading cryptocurrency, and the list goes on and on. You're not seeing those on these programs. And if you do those wrong, here's the one lesson I would leave your viewers. The IRS does not audit you and give you more money back. If you leave off a perk, if you leave off a benefit, if you leave off a deduction, that money stays gone forever.
And you can't go back necessarily.
You can go back. There's good news, bad news. You can go back 3 years. So if you're watching this and you've already filed and you didn't take one of those deductions, oh darn, you can amend your return for up to 3 years. Now, the bad news, as I said, the IRS also has 3 years to come and look for something that you might have misunderstood from Uncle Bob with TikTok, that I don't have to include hobby income or by March Madness winnings. Yeah, you do.
Okay. So lots of implications here. Now, one thing we've been hearing so much, we do have the jobs report out this Friday, and we've been hearing just about government layoffs. How is that impacting the IRS, and will that impact our tax returns?
Yeah, we heard a lot of that at the beginning of the year, especially when the Doge cuts happened and the reductions in IRS. We're seeing none of that. We're seeing the fastest processing returns and refunds that I've seen.
Is this AI? What's behind that?
No, I think that they really just kind of moved people around, and I don't know, and I won't speculate on maybe they had too many people or they didn't have the right people, but their call centers are fully staffed. People are answering calls even from professionals. The refunds, 9 out of 10 in 21 days or less, and quite honestly, we're seeing them faster than that. And the reality is they're processing returns. You send it in today, you'll get your acknowledgement same day in most cases, unless you've changed some things or answered some questions wrong or made a foot fault.
All right, Mark, lots of great implications. Definitely make sure you file your taxes by April 15th. I appreciate you joining us on set. Thanks so much.
Go get your money. $400 billion is looking to change hands, but you got to raise your hand.
All right. Just waiting out there. We will take advantage of it. Thank you so much, Mark. Coming up, we're taking a look at today's trending tickers. You're watching Market Catalyst. Time for some of today's trending tickers. We're watching NVIDIA and Marvel, Biogen and Apellis Pharmaceuticals, and Eli Lilly and Centessa. First up, NVIDIA is investing $2 billion in semiconductor company Marvel. The deal will connect Marvel's technology into NVIDIA's AI factories and ecosystems. The partnership will also see the two companies work together on silicon phonetics technology. And NVIDIA's CEO Jensen Huang added this tie-up will make it easier for customers to leverage their AI infrastructure as AI demand continues to skyrocket. Now, the investment also comes amid a series of several $2 billion investments by NVIDIA on multiple technology companies in recent months. We'll keep a lookout for that one. Next up, let's take a look at Biogen. It will buy Apellis Pharmaceuticals for $5.6 billion. Apellis stock is soaring over 3 digits on the acquisition. The move reflects Biogen's push to expand its rare disease drug portfolio as revenue from its exclusive multiple sclerosis treatment winds down. The deal will allow Biogen access to Apellis' treatments for rare kidney disease and rare blood disorder. Finally, staying in the pharma space, Eli Lilly will buy sleep drug maker Centessa in a deal worth up to $7.8 billion. Shares in Centessa are surging as this also marks Eli Lilly's largest acquisition since 2019. Now, Centessa is developing medicine to treat sleep disorders, including narcolepsy. The deal marks Lilly's expansion into the neuroscience space as it seeks to diversify its drug portfolio in addition to its lucrative weight loss drugs. And sticking with that same exact theme, AI in healthcare is on the rise. One startup, Doctronic, offers an AI doctor, and it's piloting a prescription refill service where you don't even need a doctor. Joining us now is Dr. Adam Oskowitz, Doctronic co-CEO. Adam, first break down how exactly this business works.
Yeah, so it's an AI native care platform. The AI is always free. And when you're ready to see a doctor, we can seamlessly connect you to one of our doctors. We practice in all 50 states.
Now, you are piloting something very specific within Utah, but this also comes on your latest funding round. You raised around $40 million in a Series B funding. And with that, do you plan to expand this to other states?
Yeah, so we want to do two things. First, we want to expand the program to other states through regulatory pathways. And second, potentially expand the scope of what we're doing. We started small with Utah. We wanted to focus on prescription renewals. It's a safe place to land. But I think that there's more room here for us to grow.
So how many more states are we looking at here over the next year?
Well, that depends. We have to go through the state sandboxes to do that. We're in discussions with 3 states at this point: Texas, Arizona, Wyoming. Hopefully additional sandboxes come online during the course of the year.
Dr. Adam, I did speak to one of your investors, Bradley Tusk, at the end of 2025, and we were talking a lot about how regulation is next at the forefront for AI. How are you thinking about that? How are you navigating that?
So we've taken an interesting approach. What we've said is AI care, or as we like to call it, AI doctors, should be regulated at the state level. And the reason is it's really the practice of medicine. And so the practice of medicine is regulated at the state level, and that's why we're going state by state through sandboxes to try and change regulation to allow some form of autonomous care. I think the big picture is there's a fundamental supply-demand mismatch within medicine. There's just not enough doctors to meet the demands of patients, and we need to use technology to improve that.
What we also have been hearing in an op-ed in the Washington Post, we saw one doctor say that AI development is outrunning the regulations designed to govern it, raising serious risks to patients as a result. What do you make of this pushback, and what's your response to that?
I think it's natural. There's always going to be people that are skeptical. Importantly, we're doing this in a safe way. We like to call it controlled autonomy. Every step along the way, we check to make sure that it is safe, comparing it to human doctors.
Now, as far as someone who maybe thinks, okay, medical conditions, they can change so fast. One day I have this, the next something else. How do you sort of assess that if a patient is not thinking maybe that their condition has changed so fast, but it actually has?
Yeah, that's the beauty of this new technology that we're working with. It's actually dynamic. It's designed to tease out the information it needs to gather that new information that may have happened over the course of a couple weeks or a couple months since you've actually visited a doctor or our platform.
When you think about the demand that you're seeing right now, especially as you do go to these other states, what's the adoption rate here? And from what I understand, it's only about $4 for this sort of subscription purchase. So how are you thinking about that scale moving forward and that price point, especially as consumers are thinking, okay, where can I cut off in my budget with all these higher prices around me?
Yeah, when you start doing things autonomously, just with AI, the price point comes down dramatically. And I think ultimately that's going to drive adoption. It's going to be both from the consumer who's watching out how much they're spending, but also at the state level where Medicaid is under pressure, payers that are always trying to reduce the overall overhead, and eventually health systems that are trying to make themselves more efficient.
What we have seen in the past year, we were off to a hot start in 2026 when it came to funding by VCs, especially around AI companies. I'm sure, Dr. Adam, I'm sure you talked to a lot of other founders out there. What's the scenario now, given this war that we have with Iran? What are you hearing from other founders right now when it comes to the VC activity and the deal making that maybe we saw as high as last year? I mean, last year we saw a record deal values. We also saw deal count come down, but deal values go up.
I tend to see there's winners and losers in this particular scenario. I don't think it's necessarily right or wrong, but there's a large amount of capital going after a small amount of companies. Those deals naturally ebb and flow because there's fewer deals out there. But I continue to see that as we're talking to investors.
This was just your Series B funding round. What's next? Will this eventually be a company that could go public in the future?
I think just by the nature of what we're doing, it's a public interest. It makes sense for us to become a public company eventually. We want to be transparent in what we're doing. We're doing something transformative. It's a little scary for people. At the same time, it has immense value. And being a public company allows us to be a little bit more transparent with that. So it does make sense for us eventually to get there.
All right, lots to look out for. Dr. Adam Oskowitz, thank you so much for joining us. Appreciate your time.
Thank you.
And coming up, a check on crypto as we close out the first quarter of 2026. Stay tuned. You're watching Market Catalyst. Let's get a quick check on crypto, brought to you by the National Cryptocurrency Association. We are seeing Bitcoin and Ethereum move higher based on the implications of this war in Iran potentially ending, according to President Trump. We are seeing Bitcoin move higher, up about 0.4%, and this could snap the losing streak that Bitcoin has had since September. If you take a look over the past year, we are down about 18%, and over the past 6 months alone, what we have seen is this sell-off within Bitcoin down about 41%. But once again, today we are trying to hold on to some momentum there, now up about 0.3%. That's extending into Ethereum, which is actually seeing a bigger gain on today, up about 1.10% for the day. If you take a look over the past 6 months, though, Ethereum has gone down as well, down about 50%. So definitely some optimism returning to the market as well. I do want to take a look at our cryptocurrency heat map. What we are seeing there is a bit of a mixed picture. If you do go to equal weight, we are seeing some leaders in the gain, but we are seeing Bitcoin still around here, and most of them in the red, including Solana. Solana down about 2.5% on the day, and that as well also seeing over the past 6 months some downward pressure, down about 61%. This also extending, this optimism extending into the crypto stocks, with Robinhood, Coinbase, and Circle seeing some upward momentum today. But on top of this, a new Wells Fargo money study shows a shift towards entrepreneurship, with nearly 70% of Gen Z seeing business ownership as core to the American dream. Yahoo Finance's Josh Lipton spoke to Emily Irwin, head of private wealth planning at Wells Fargo, about the study.
Emily, great to see you on set. So let's dig into this. So your study says Americans now, they're redefining the American dream. And one big shift you all mentioned is this shift towards entrepreneurship. That's interesting. Explain that. Why do you think more Americans now saying, you know what, owning my own business, that's the move, that's the goal?
Yeah, well, I think there's a few reasons. The first is they've come up through the gig economy. So they've gotten used to being able to exercise their muscle memory of entrepreneurship at a very young age. And there's a control aspect to that they really enjoy. And we're seeing a little bit of the economy getting to them. So first is they want to prioritize saving, they want to prioritize investing. This is the way to do it. We also know that there's a really positive emotional aspect when you feel like you're controlling your own finances. We saw that in the survey. And most Americans, including Gen Z, believe that if you're an entrepreneur and you own your own business, you can control your own destiny, and that continues to foster that emotional kind of like feel-good feeling that you're controlling your destiny.
So those are the potential sort of advantages of entrepreneurship. Yeah. What would be some of the downsides, the risks you got to think about?
Well, I think there's obviously a reality to owning a business. Certainly there's commingling of personal and business assets. Many entrepreneurs actually cite the fact that they have to leverage some of their personal credit, their personal debt. That could even mean their home in some cases, which can be the ultimate personal asset that you have in order to continue on in the business and grow. And so while you have that great responsibility and opportunity, it really does come with an appetite for, do you have that risk on a day-to-day basis to understand that you are creating your own income and creating your own destiny. In some cases, you're responsible for employees in the community as well.
Another, I thought, interesting stat that jumped out, Emily, in your study to me, was side hustles and how they're becoming more popular. And I was wondering whether you looked at that and said, oh, that's a good thing. That's ambition, opportunity, getting after it. Or no, was that actually some kind of was that a sign of actually financial strain for a lot of people?
I think it's both, potentially. I really think that one thing, people are making it work for them. So if they need to do the side hustle, we're seeing a recommitment to wanting to be intentional with their money and to want to prioritize saving. We've in fact, over the last 2 years, seen almost a 10% increase in prioritizing saving and investing as a personal goal. And I think people are understanding that in order to make it work, if we have to go out and get a little bit gritty in our downtime, in our free time, we're willing to do that and put in the hard work. What I think is fascinating, though, is because of this kind of muscle memory, we are seeing that shift to saying, you know what, maybe that home purchase, we're willing to delay that in order to do our side hustle. We're willing to delay that in order to build a business and maybe invest in a business. And that American dream is a little bit being reinvented in real time.
I was also surprised, Emily, in your study when I saw how many Gen Z Americans are actually relying on mom and dad.
Yeah.
What did you make of that?
Yeah, the bank of mom and dad. It's so almost 60% are receiving financial support from their parents. What was fascinating to me is that the parents themselves have this strong commitment to want to do this. Over 80% said, like, we want to be able to do this. That is a shift in a mindset. We've seen this from our customers, and it's supported by our money study. People want to see their dollars in real time during their lifetime at work, as opposed to waiting to that inheritance at death. So that's the first thing. However, what was maybe the tension that I saw was parents are also feeling a strain, more than half of them, with this financial support that they're actually giving to their kids. So I would say, like, hey, Gen Z, parents, let's get together. Like, silence is the ultimate deal breaker. Let's start having real tactical conversations about what that support looks like, maybe setting timelines, setting goals, understanding, is this a loan? Is it a gift? Is there a certain date certain where we're going to not be able to do this anymore, or where there's, I hate to use the word expectation, but an expectation that you're going to launch independently. And those are the conversations that I think right now are missing. And if those were happening, then that number would give me a lot less concern.
Here's one. Nearly half of Americans say they're saving more and being more intentional with their spending. What did you make of those trends?
Yeah, well, I think those trends are not necessarily surprising given the last few years that we've seen. So we've come off of higher inflation, interest rates are higher. I think one of the other data points is that we know that many individuals feel like their lives are financially messy, and they don't really know how to start. And in some cases, they're wondering, do I even have enough to start? By saying they want to be more intentional and they want to save more, that's actually the first two imperative steps you can take, because that takes all the chaos and all the distraction out of it. You can go analog, you can go digital, but really what you want to do is say, what does my balance sheet look like? And then what do I want to accomplish with my dollars? And once you can kind of work that in, that intentionality, it becomes much more clear what the path forward can actually be. It also helps you seek out the right type of advice.
Let's end here, Emily, on AI, because this is a good stat. Nearly 1 in 5 Americans, you report, are already using AI for financial decisions. That's interesting.
Yeah.
What do we have line of sight? I mean, what are they using it for? And do they find it useful? Do they find it effective?
Yes, we do. So we have a staggering stat. 80% look for it for financial education. Almost 75% look at it to identify new strategies they can implement. And more than half of the individuals are actually implementing those ideas. In a truly stunning moment, over 90% of the individuals in our survey said that it was a profitable decision when they implemented it.
Yeah.
Now, here's my caution though, and I will say, we see Gen Z double the rate of adoption as all adults in the United States, and I think it's a fabulous tool. I love AI for education and to be able to really drill down into personalization. Go out and get second opinions too. Like, don't be afraid to go around and say, like, here's the path and the guidance I received. And hey, if you're receiving support from the bank of mom and dad, go out and ask your parents what they think, and maybe go out and ask a more traditional source and then reconcile them to determine if it's the right financial advice for you.
All right, Emma, great to have you on the show today. Thanks so much for your time.
Likewise.
Appreciate it.
Coming up, your chocolate bunny could cost you more this year, why Easter candy won't be any cheaper even as cocoa prices stabilize. That's next on Market Catalyst. It's now time for one of my favorite topics to discuss, and that is chocolate, because new data shows the cocoa market is finally starting to stabilize, but that won't mean cheaper candy this Easter. Candy prices have risen nearly 12% year over year. That's according to the Bureau of Labor Statistics. And shoppers, like myself, might not feel relief until later on this year. Joining me for more is David Branch, Wells Fargo Agri-Food Institute Sector Manager. David, thanks so much for joining me. As you can or cannot tell, I absolutely adore chocolate. It is a guilty habit of mine. But based upon what you're saying, there's lots going on that's implying higher prices are here to stay for a bit. So rack us up here. What's going on in the cocoa market that it's now stabilizing?
Well, we've had, prices skyrocketed to over $12,000 a metric ton in 2024. And that was following multiple years of crop shortages and creating a deficit supply. We've had excellent weather, particularly in, the West Africa, which grows 70% of the cocoa bean supply. So, expectations right now and current harvest reports are coming in significant, and the ICO, International Cocoa Organization, is estimating we will erase that deficit and have a surplus during this crop year. As a result, prices have moderated, and we're actually trading back down into $3,000 to $4,000 a metric ton right now. Problem is, those prices didn't start coming down till early February. And so what we're seeing is the candy that's on the shelves right now was manufactured when that cocoa was bought at $6,000 to $8,000 a metric ton. So those higher cost cocoas baked into what's on the shelves right now. So it's going to take a while for this whole thing to trickle through the system before we maybe see some price relief on the shelves.
Okay, so David, we could likely expect maybe similar prices to what we saw around Valentine's Day, which were still pretty high. When you think about what this global surplus means moving forward in 2026 and beyond, what needs to keep happening in order for this market to continue to stay stable?
Well, what we're seeing is part of the surplus is coming from, we have several other countries, I know in South America, that have planted a lot of new cocoa plantations, and those are finally coming online. So that's also helping to ease the supply crunch. So we're going to see more production, not just centered on West Africa, to kind of spread the weather risk around. So I think we continue to see more and more of new plantations come online. We also know a lot of the public companies, large chocolate manufacturers, are working within these countries to help improve cultural practices in these plantations with these individual farmers. So that should also help improve productivity of what we have right now in West Africa. So I think, barring any other foreseen another drastic weather event, I think we're going to trade. Consensus is probably trade in the $3,000 to $4,000 to $5,000 a metric ton, and not really get back up to the 10 to 12 for the near future.
So, David, lower prices by Halloween. Fingers crossed.
Fingers crossed. Yes. I mean, manufacturers, prices go up, costs go up. They're quick to raise those prices, but they become very sticky. And you don't know what's going to drive it back down. So what we're really looking at now is comparing volume of sales versus revenue. And it's going to have to come to a point when management looks at, I'm losing too much volume at the price point I'm holding, I'm going to have to drop that down. So hopefully we see some give and take by Halloween, and prices, even if they just stay flat, would be a bonus right now, given what's happened over the last couple of years with candy prices.
David, I do want to get your quick take, because we're talking a lot about higher diesel prices. Just how fast do higher transportation costs hit what Americans see at the grocery store on the shelves?
Actually, diesel, because of the taxes which are put into it, filters pretty quick. It takes 2 to 3 week lag from when a higher diesel price kicks in to when it starts impacting. Just looking in basic terms, for every $1 increase in the price of diesel fuel per gallon, that adds up to about 6 to 8% per mile increase in transportation costs. And so we're only up, just from 269 to, right around, I think we just top 5 in some states or whatever. So we're talking about 10 to 12 cents a mile transportation costs, but that's going to take a little while to trickle in. So as far as Easter candy, it's not going to be impacted by the rise in diesel because all that candy's on the shelf right now. But, it's a 2 to 4 week lag before those prices start filtering into higher transportation costs.
David Branch of Wells Fargo, thank you so much, and I hope you enjoy your holiday this year, and hopefully you're buying up more at the shelf, even though there's still higher prices. Thanks so much.
Yeah, we're going for quality, not quantity right now at my age.
Exactly. I'll admit I'm a fan of the Cadbury eggs, but that's it. Well, that's it for Market Catalyst. I'm Brooke Tabama. Thanks so much for watching. More Yahoo Finance ahead.